Hello, everybody. Thanks for watching the video today. I'm Terrence Boykin with Boykin Realty, brokered by Keller Williams. We have today with us Eduardo Rodriguez, one of my favorite local community bankers. Today, we're going to be working on our new construction series of videos, and we're going to be talking about financing for new construction. And there are a lot of little different issues that come up specifically with new construction financing. So I'll start talking a little bit about financing for tract builders or some of our larger builders in the area and across the country. Those are pretty cut and dry, not too much off of normal financing. As a buyer, we always want you to be pre-approved so that we really have a good idea of how much home you can afford, and we can do any work on your credit before we go to that builder. A few wrinkles that do get thrown in with new construction as far as tract builders go is that oftentimes they will have what they call preferred lenders, and those preferred lenders may offer $1,000 to $4,000 off closing costs if you use them. I do caution you one thing on using those preferred lenders. Sometimes that money might be a little funny money. So I recommend that you do have a trusted lender give you an opinion outside of that builder, and then compare the package that the builder gives you to see that they truly are giving you $3,000 off your total price. Another thing with new construction on the tract builder side is that they are oftentimes willing to work with you on a contingency, and that means you have to sell your home before you purchase that home. And they normally will do that. I've got one right now that it's an inventory home. That home was already built. We went under contract and they gave us 60 days to get my client's home sold. One thing your agent can do to give you the best benefit is have all the information for your home ready, how many days on market, the comps for it, so that builder feels comfortable that that house is going to sell. Now, for some of you, that may have just sounded like a lot of information, but it really wasn't. And that's why I've got Eduardo here with us today, because one of the most confusing things around new construction is construction loans, construction and permanent loans, and the different ways of going about it. And I know a lot about real estate and what goes on with buying and selling of houses specifically. When it comes to some of the more focused things in on the lending side, that's when I back up and say we probably need to talk to a professional on that. And that's just what we're doing today with Eduardo. Eduardo, can you give us a little information about construction loans, especially when we're dealing with some of the smaller builders and custom builders?
Of course. Well, thank you, Terrence, for having me on. And construction lending is typically a hot topic as of late. A lot of folks are interested in construction lending. On the bank side, and as a banker, when we're talking about construction lending, that is one of our more riskier loans, and so it requires a lot of due diligence, just because there's so many moving parts. And so, as a consumer wanting to build a home, one of the things you want to look at is making sure that you're choosing a reputable builder. That's one thing that the bank is actually also going to look at. So not only are you looking to get a loan from the bank to build your home, and we as the bank are going to pre-qualify you, if you will, we're also going to be looking to qualify that builder to make sure that they have their license is current, that they've paid their subcontractors on time, that they have a reputation for getting the job done and not leaving anything out there lingering. Because the last thing the bank wants is for you as a customer to have a bad experience. You choose a builder and then they, for whatever reason, can't complete the project. A few things to consider when looking at building a home. One of the things you want to look at is, are you going to purchase the lot yourself, or are you going to have the builder purchase the lot for you, or are you going to include that in the construction process? You can actually do all three. And with the construction loan, typically it allows you to purchase the land with the first advance, and then have additional advances as the construction phases begin through the process. And it allows you to also just pay for what has been used. And so when you're going through the construction phase, you're actually just paying interest only payments as advances are being made. So just a couple things to point out there. But I know, Terrence, you probably have gotten a lot of questions from homeowners on, how do I pre-qualify, or how do I, once that the construction loan is completed, how do I get a mortgage? Is that kind of what you're hearing?
A lot of those questions, and questions specifically on what you just talked about on those interest payments. Okay. Can you give us an idea of what those interest payments would amount to? Let's say for $450,000 house, sure, maybe a $70,000, $80,000
sure,
lot.
Sure. So let's just do some quick calculation for everyone here. So we're gonna assume we have a build of 400,000, and let's say the lot purchase is 100,000.
Okay.
And so that 100,000 is the first advance that we're going to do from the construction loan, and that is an amount that's spread over basically over 12 months, because typically in construction lending, it's going to take about 6 to 8 months to build a home, maybe a little bit longer, up to a year if it's a bigger home. And so the interest on about 100,000 is around $400. And so that gives you an idea of when you first get the construction loan and the first advance is to pay off the lot, then your monthly payment for that amount is around $400 worth, or $500 worth of interest. And then as the phases start, so for instance, the next phase is the foundation. And so once the foundation is complete, that might add another $10,000 to $15,000 depending on the foundation, if you don't have a basement, and that will add maybe another $100 to that amount. And so that's the process that will continue until the house is complete, and at which time the mortgage actually, it's almost like a refinance. The mortgage actually pays off the construction loan.
Got it.
Yeah.
Got it.
What other questions I can answer about?
I've heard some lenders say that on a construction loan process, they have a one-step close, and some, I think maybe like you just mentioned, have a two-step close.
Okay.
What are the differences between those two?
Sure. So the one-step close is where the customer goes to their bank and applies for the construction loan and the mortgage all at the same time. Okay. And so it's a real estate transaction. And so similar to the two-time close, there's going to be a construction loan. They're going to be making payments on that construction loan while that's actually, the home is being built. And then it automatically will turn into the mortgage once the home is complete. The benefit to the customer is that they only have to pay closing costs once. They only have to do that transaction once. The con to that is that amount is fixed. So for instance, if the builder says, I can build you this home at $400,000, well, they're going to get the loan and it's going to be a mortgage at $400,000. So if for whatever reason, through the process, the customer says, well, I really had designed the laundry room to be on the downstairs floor, but I want it now on the second floor. Well, that's considered a change order. And so those change orders would have to come out of pocket. And so you're locked into whatever that budget was at the beginning of the stage with that one-time close. Okay. Whereas with the two-time closing, those are two different loans and they're both separate. But you as the consumer have a little bit more of a leeway as far as the money is concerned. Because if the home, let's say, is supposed to be $400,000, but because of lumber cost or other material costs, that cost actually comes in at 350, well, then your new mortgage can now be 350.
Okay.
Whereas in the previous scenario, the single closing, it's only going to be one.
With that question, and if you're watching this video later, we are filming this video during the COVID period of 2021. With the one-step closed, if a client was buying a $400,000 house, let's say this process started 2 months ago or a month ago.
Sure.
The builder has now done the foundation, getting started, and he gets the message that now there's a $20,000 or $30,000 increase on his lumber prices or just prices. With the one-step close, would that buyer have to pull that extra $20,000 to $30,000 out of pocket, or are there contingencies for that?
So typically the builder will have at the beginning of the stage what's considered a budget cost sheet. And in that budget cost sheet, there is going to be about a 10% contingency buffer in that. And so that probably may come by that. But in the two-time closing, for instance, the customer is going to have just a little bit more leeway. So if the builder says, hey, this construction loan, the foundation, it's going to cost maybe $10,000. You may decide, well, let's put the budget at $12,000 just in case we were going to do anything different to the foundation, or if we decide to put in a crawl space versus a slab. So.
The last question I think I have right now is, let's say we do the construction to permanent loan, we're paying interest up until and we're doing a two-step close. We're paying interest up until the home is finished. Is there a typical down payment amount at that time?
There is. So there's typically a 10% down payment that you're putting into the loan. However, if you already own the land, for instance, then that could be considered your equity. So you wouldn't have to necessarily come out of pocket for that. One other point that I just want to point out, because a lot of my customers are also business customers, and you may have some business customers out there where they have an accountant or CPA that do a really good job at reducing their tax liability, which lowers their income. If you are a business owner and looking to build a home, you probably want to make sure that the year before or even 2 years before that you're not taking as many deductions, because that will affect whether or not you qualify. Because what the bank is going to do is they're going to look at your income. They're going to verify that you can make the payments on this new construction loan, and then later down the road the mortgage. And so if you are historically reporting a lower income than you could, you want to take a look at that and make sure that you have a tax return that's going to have an income that substantiates the cost of the home that you want to purchase.
That's a great point. That's something that I really didn't think of. And I do work with a lot of buyers a year or more out. And that's something I've never mentioned to them that makes complete sense, is to start planning your expenses and your income, yes, so you can afford that house. That's a great point. Yeah. Anything else you want to give us? I'll definitely.
That's a few nuggets of wisdom.
Got it.
Yeah.
Okay. Well, that really helped Eduardo, even with me, with understanding that construction to perm. And guys, you will hear the term construction to perm loan, and that's what we just talked about. So if you hear that, if you have any questions, I will have Eduardo's contact information below. So please feel free to reach out with him. He's very helpful. He helps me and my business through a lot of things, and is always there for my clients. Thank you, Eduardo, for being on the video today. Thank you for watching. And if you have any suggestions for future videos, please let us know at RaleighsBestAgent.com. Have a great day.